Hi, let's check the question first. Okay. So, with the use of a diagram, explain how prices allocate scarce resources in a market economy. So, that's our question. Let's see how to answer them. What are the points we have to add while we are answering the question? So, basically, in a market economy, okay, prices act as a signal and an incentive mechanism. So, what is incentive mechanism? Incentive mechanism refers to how changes in price motivate consumers and the producers to change their behavior. So it's obviously right. Whenever the price of a good changes, our consumption and the producer's production decision will change. That is what we call as incentives. Okay. And that is also the signals, right? The price is a signal whether we have to buy it or whether we have to skip it like that. So, what are the benefits of that? It allocates scarce resources through the forces of demand and supply. So, as a result of the price change, what will happen? There will be some changes in the demand and the supply, right? So, we'll be able to allocate them. So, let's see how to do it. Okay. So, before that, let's check what do we mean by scarcity, the scarce resource. So, scarcity means that the resources, what are the resources like land, labor, capital, all of these are limited, right? But human wants are unlimited. So if there is no restriction or if there is no constraints, we will misuse the resource, right? The resources are completely limited. So if there is no restriction, the resources will completely deplete. We won't have enough to consume later, right? So we have to be very careful with those usage, right? So let's see how to solve this issue. So not everyone can have everything, right? The choices must be made. So for example, just imagine that like if a product is luxurious product, okay, it's cost you much higher prices. Not everyone will be buying that, right? Only those who can afford it can achieve it. Okay, so this is how the resources are allocated. Okay, so only those who are able to buy it will be able to get it. Okay, so let's see how this price mechanism is working. So for that, we can use the common demand and supply, the normal demand supply graph. Okay, so in the graph, we have the demand, the downward sloping curve. We have the supply curve here. Okay, so the initial equilibrium is at a Q star and a P1. Okay, this is the initial equilibrium. Okay, so where the demand is equal to supply, right? That is where the equilibrium is. This is our initial equilibrium. Okay. So in this is the market equilibrium. Resources are efficiently allocated at this point. Okay. So there is enough to satisfy everyone's demand. And what will happen if the price is above the equilibrium? If the price is above the equilibrium, that is, if the price is peak, what will happen? The producers will be supplying because they could earn more profit, right? For example, initially the price of the product is 10 rupees. Okay. And now they are selling it at a price due to higher demand or whatever it is, the price has increased. Now the producers are selling it for 20 rupees. So they'll get double profit, right? So definitely they are going to make more products and they will supply it more. As a result, what will happen? More supply will be there in the market. And what about the demand? When the price increases, definitely the demand will be reduces, right? So it will change to Q1. Okay. The demand will be reduced. As a result, there will be excess supply in the market. Okay. The product remains unsold. Okay. So that is what happens in the price above equilibrium. At the P2, the quantity supplied will be greater than quantity demanded. Firms cannot sell all their products. So there will be a surplus supply. And to clear the stock, firms will lower the prices. Okay, the firms will have to lower the prices. And this reduces the supply and increases demand, moving back to the equilibrium. Okay, so it will again come back to this particular equilibrium level. Clear? So this is what happens when we sell some product at the more than equilibrium. Okay, clear? And now let's check the price below equilibrium. Okay, the price below equilibrium. So what if the firms are selling it below the equilibrium price? Okay, so what will happen? The demand will increase, right? When the product's price is reduced, definitely the demand will increase. And what about the producers? They won't get more profit, right? So definitely they will have to face some loss. So they will reduce the quantity supplied. As a result, there will be a shortage of supply or surplus demand. Here, demand is more, right? Quantity demanded is greater than quantity supplied. There is no enough goods available. So the market will have a shortage. As a result, consumers will compete, right? And they will be pushing the prices up. They will be willing to offer more to just to get the product. This reduces the demand, okay, and increases supply, moving back to the equilibrium. So basically, what is happening there? The market will always try to get back to the equilibrium in the normal case. Okay, so when the supply gets equal to the demand, the market will be at equilibrium, and the price at that time is equilibrium price, and the quantity demanded at that time will be equilibrium quantity, right? And due to some other changes, maybe the resource is not available much, or due to increase in any other cost or something like that, the price can go up, right? So if the price goes up to P2, what will happen? It will affect the demand, right? So for example, just imagine that for a particular person, his monthly salary is 10K. Okay. So when the price of the product is 10 rupees, he used it to buy around 20 units or something like that. But when the price goes up, he is not able to buy 20 units. He could now only afford 10 units because his salary or his income remains the same. Okay. So what happens when the price is increased? More people are not able to buy it. Okay. More people are not able to buy it. Okay. So far we have understood that how this price mechanism is working, right? So when the price is increased, less product demand will be there and supply will be more. And when the price is decreased, more demand will be there and less supply will be there. So the same price mechanism can be used to allocate the scarce resources. Let's see how. Okay. So when the resources is scarce, if more people are able to buy it, the resource won't be enough to satisfy everyone's need, right? So those who are in most need, like those who anyway wanted that particular resource, they should be able to get. So that we'll be using this price mechanism. So when the resources are scarce, we can increase the price of that particular product. So, when the resources are scarce or limited, so not everyone can consume the good, right? So, the price will act as a rationing device. So, only those who willing and able to pay can buy the good. So, if it is an essential good for that particular person, if they are willing to buy it at any price, no matter what, they will be purchasing it that anyway. So, those who in need will get the product, and others can just ignore it. Okay. So what happens here when the resource is scarce? Okay, when the resources are scarce, we can increase the price. Okay, as a result, demand will fall, right? And even though the supply increases, it doesn't matter. Okay, and at the same time, when the price falls, demand will increase, but supply will fall. So no matter what, the product won't be sold more than a particular quantity and the resource won't be depleted. So price allocates scarce resources through the price mechanism by rationing the goods, signaling shortages and the surpluses, and providing incentives for producers and the consumers to adjust the behavior. So they ensure the resources move upward toward their most valued uses. Okay, so it will make sure that the scarce resources are used for their most valued uses. Okay.